Have you ever wondered who actually decides your mortgage rate? Most people think it's the bank. Some think it's the Federal Reserve. But the truth is, neither one sets the number directly. Your mortgage, your car loan, your retirement savings, even the interest you earn on your cash is influenced by something most people never look at: the bond market. It's a financial market worth more than $145 trillion, quietly affecting almost every major financial decision in your life. In 2022, this same market caused the safe portion of millions of retirement portfolios to lose more than 13% in a single year. The worst bond market decline in decades. So what exactly is a bond, and why does it have so much power? The answer is surprisingly simple. A bond is nothing more than a loan. Instead of borrowing money from a bank, a government, company, or city borrows directly from investors. You lend them a fixed amount of money, called the principal. In return, they promise two things. First, they'll pay you regular interest payments, known as the coupon. Second, they'll return your original investment on a specific date called the maturity. That's it. The idea is simple. The reason bonds become so important is because governments borrow enormous amounts of money. The United States alone currently owes more than $39 trillion in national debt. Even more surprising, the government now spends over $1 trillion every year just paying interest on that debt. And here's why that matters to you. The interest rate the government pays isn't chosen randomly. It's determined by the bond market. And that very same market also influences the interest rate on your mortgage. To understand how, you only need to remember one rule. When interest rates go up, existing bond prices go down. When interest rates go down, existing bond prices go up. These two always move in opposite directions. Here's a simple example. Imagine you buy a bond for $1,000 that pays 3% interest. That means you'll receive $30 every year. A few months later, new bonds are issued paying 5% interest. Now investors have a choice. Would they buy your bond paying only $30 or a new one paying $50 for the same investment? Obviously, they'll choose the new bond. So if you want to sell your old bond, you'll have to lower its price until buyers are willing to purchase it. That's why rising interest rates cause existing bond prices to fall. This one simple rule explains almost everything that happens in the bond market. And it also explains why your mortgage payment can change, even if you've never bought a single bond in your life. In the next part, we'll see how one small move in the bond market can quietly add tens of thousands of dollars to the cost of buying the exact same house. Out of the entire bond market, one bond matters more than almost any other. It's called the 10-year U.S. Treasury. Banks watch this number every single day because it acts as the benchmark for many types of loans. Think about it. If a bank can lend money to the U.S. government with very little risk, why would it lend money to an ordinary home buyer for the same return? It wouldn't. That's why banks usually take the 10-year Treasury yield and add a couple of percentage points to cover the extra risk of lending to individuals. This is why mortgage rates rise and fall with the bond market. Let's see what that means in real life. Meet Brian. Brian wants to buy a home and needs a $400,000 mortgage. When mortgage rates are around 6.5%, his monthly payment is about $2,530. Now imagine the 10-year Treasury rises by just 1%. That's a completely normal move in the bond market. As a result, Brian's mortgage rate also increases by about 1%. His monthly payment jumps by nearly $270. That might not sound like much. But over the next 30 years, Brian ends up paying almost $97,000 more for the exact same house. Nothing about the house changed. Brian's salary didn't change. The neighborhood didn't change. The only thing that changed was a number in the bond market. Now compare two real periods. In early 2021, mortgage rates were close to 2.65%. By late 2023, they had climbed to nearly 7.8%. For the same $400,000 loan, the monthly payment increased by well over $1,200. Over the life of the loan, that difference adds up to hundreds of thousands of dollars. That's the hidden power of the bond market. It can make the same dream home dramatically more expensive without changing a single brick. But mortgages aren't the only thing affected. For decades, financial advisors gave retirees one simple piece of advice. When you get older, move your money from stocks into bonds. Stocks were meant for growth. Bonds were supposed to provide safety. The famous 60-40 portfolio became the standard retirement strategy. But in 2022, something happened that shocked millions of investors. The safe side of the portfolio wasn't safe anymore. Instead of protecting investors, bonds suffered one of the worst years in modern financial history. And many retirees discovered that the investment they trusted most could lose far more than they ever expected. In 2022, the U.S. Federal Reserve raised interest rates at the fastest pace in more than 40 years to fight inflation. And remember the one rule we learned earlier. When interest rates rise, existing bond prices fall. That's exactly what happened. The broad U.S. bond market suffered its worst annual decline in decades. Millions of investors who believed bonds would protect their retirement savings watched their portfolios fall sharply. So why did some bond funds lose much more than others? The answer is a number called duration. Think of duration as a bond fund's sensitivity to interest rates. The higher the duration, the more the fund's value moves when interest rates change. For example, if a bond fund has a duration of 6, a 1% rise in interest rates could cause its value to fall by roughly 6%. A duration of 15 means that same rate increase could lead to a loss of around 15%. Many investors never even look at this number, but it can make the difference between a small decline and a major loss. There's another important detail that surprises many people. Owning an individual bond is very different from owning a bond fund. If you buy a single bond and simply hold it until it matures, temporary price swings usually don't matter. You'll continue receiving your interest payments, and assuming the issuer doesn't default, you'll get your principal back at maturity. A bond fund works differently. It doesn't have one maturity date. It's constantly buying and selling bonds, and its value is updated every day. So when interest rates rise, those losses appear directly in the fund's price. That's why many investors saw their bond funds fall sharply in 2022. Not all bonds carry the same level of risk either. U.S. Treasury bonds are generally considered among the safest because they're backed by the U.S. government. Corporate bonds are different. Companies can run into financial trouble or even go bankrupt. Because of that extra risk, investors demand higher interest rates from companies than from the government. The difference between those yields is called the credit spread. When that spread starts getting wider, the bond market is often warning that investors are becoming worried about the economy. And when fear increases, something interesting happens. Investors often sell riskier assets like stocks and corporate bonds and move their money into U.S. Treasury bonds. This is known as a flight to quality. As more money flows into treasuries, their prices rise and their yields fall. That's why in many market downturns, government bonds have traditionally helped offset stock market losses. But 2022 was different. The problem wasn't a recession. The problem was rapidly rising interest rates. Those higher rates hurt both stocks and bonds at the same time. The strategy that had protected investors for decades suddenly stopped working. And that's exactly why 2022 became one of the most unusual years in modern investing. There's one final part of the bond market that's worth understanding because it has predicted nearly every U.S. recession over the past several decades. It's called the yield curve. The yield curve simply compares interest rates on U.S. Treasury bonds with different maturities, from a few months to as long as 30 years. Normally, longer-term bonds pay higher yields than shorter-term bonds because investors expect more compensation, locking up their money for a longer time. But sometimes something unusual happens. Short-term Treasury yields become higher than long-term yields. This is called an inverted yield curve. Why does that matter? because it usually means investors believe the economy will slow down and that the Federal Reserve may eventually cut interest rates. Historically, an inverted yield curve has appeared before every U.S. recession for decades. It's not perfect at predicting when a recession will happen, but it has been one of the market's most reliable warning signals. The bond market also affects something much simpler: where you keep your cash. Many traditional savings accounts still pay very little interest. Meanwhile, short-term U.S. Treasury bills often offer significantly higher yields while remaining among the safest investments available. That means two people with the same amount of money can earn very different returns simply because they chose different places to keep their cash. The lesson isn't that everyone should rush out and buy bonds. The lesson is to understand what the bond market is telling you. A rising 10-year Treasury usually means borrowing becomes more expensive. Mortgages, car loans, and business loans often become costlier. Falling Treasury yields can signal that investors expect slower economic growth. And if you own bond funds, understanding their duration helps you know how sensitive they are to interest rate changes. In other words, the bond market isn't just something for professional investors. It's the invisible engine behind mortgage rates, retirement portfolios, savings returns, business borrowing, and even the overall economy. Whether you're buying your first home, saving for retirement, or simply keeping money in the bank, the bond market is quietly influencing your financial future every single day. Once you understand how it works, you begin to see the connections. And that's when you stop reacting to the market and start understanding it. If you found this video helpful, don't forget to like and subscribe for more simple explanations of complex financial topics. Thanks for watching, and I'll see you in the next video.